So even if the government is inflating the money supply, putting upward pressure on prices, the free market can offset that by increasing the supply of goods and services. But when people lose their jobs, the supply of goods and services is going to be reduced, and that is going to make inflation worse. You know, the same thing is true with respect to the supposed trade-off between economic growth and inflation. People are saying the Fed has to slow down the economy. We need less economic growth to have lower inflation. Again, that is trying to put the blame for inflation on the private sector. The economy is just growing too fast, and that's why we have inflation. No, it's the money supply that's growing too fast. The government is why we have inflation, not the private sector. Economic growth doesn't cause inflation. I'm hearing a lot more myths about inflation, and one of the big myths is the so-called trade-off that you have between inflation and employment and inflation and economic growth. A lot of people are saying that we need to have an increase in unemployment in order to have a reduction in inflation. This is the so-called Phillips curve, which believes that there's some kind of inverse relationship between the two. But this is false. It is Keynesian nonsense. Forcing people out of productive jobs does not fight inflation. The Keynesians are focused on demand. They think if people lose their jobs, they won't have any purchasing power. They won't be able to buy stuff, and so they'll have less demand, as if inflation is somehow a byproduct of people working and people spending their paychecks.
This is a very difficult time to make a decision between fixed income and equities because, as you mentioned earlier in the show, we've got an inverted yield curve that's generally never good. But again, when you can't tell me why we have full employment, 2.5 more million people working, and low productivity, then maybe you want to be a little careful about making more decisions about raising rates or changing policy or raising taxes. They all sound like really bad ideas until you've really figured out the riddle of what's going on in this economy. We don't know.
Exactly.
So my attitude is to stay long equities, continue at a 30% weighting in fixed income. That's very low for me. Usually it's 50%. And just wait and see what happens. My names are high quality names that provide cash flow and distributions. But it doesn't matter what sector you pick. You've been doing quite well in the last 4 weeks.
What I'm thinking, this market, and it is a difficult market, a bear market, a really, really ugly bear market gives you very few places to hide. So it's been very hard to hide in stocks. It's impossible right now in the bond market, and the bond market's been an absolute nightmare. And it's a silent scream because a lot of bond investors really don't see the carnage in prices that's happened this year. I mean, they're wondering why is my bond portfolio down? Commodities have been good, but they've been also rather choppy. And if you were in energy, you just saw a 20% drawdown off the highs, which I think a lot of macro touristy type people went into energy as they saw it booming, and they got into it rather late. Thus, it fell apart and came down.
I see Bitcoin sort of testing 20,000 all the time, getting a lot of resistance there. Seems to be holding the 2023 area. Still very profitable for Bitcoin miners that are currently mining at about 7,000 per coin at scale. And so there has been a knee-jerk reaction against Bitcoin miners lately because of ESG concerns, but they're also self-correcting by getting into nuclear and hydropower, which is plentiful in some countries like Norway. Now, crypto itself desperately needs policy. It needs regulation. And there was a bill just 2 weeks ago that was contemplated being pushed through, not on Bitcoin, just stable coins as payment systems.
We have to make up for the fact that the cost of living didn't rise by enough in a particular year, that now we have to have an even greater increase in the cost of living in a later year. But I also pointed out at that time the exact position that the Fed is now in, that what happens if inflation really spikes up? well above 2%. How do you average it back down to 2%? Well, that would require the Fed having many years of inflation below 2% in order to make up for those years that it's above 2%. Well, is anybody at the FOMC acknowledging the fact that we need to have inflation below 2% for a while to make up for 9% inflation? In fact, how many years is the inflation rate going to be well above 2%? And how many years would they have to get inflation below 2% in order for it to average 2%? In fact, if prices are already too high, making them go up by another 2% would just add insult to injury.
I'm going to put all the cash at the ECB. Or if I don't want to do that, because that creates some issues too we don't need to talk about here, I'm going to lend to the guy over there who is Google. And he's the safest company, corporation, financial bank, whatever. I'm going to lend to him at whatever rate he's going to pay me, which might even be less than the ECB rate because he's safe. He's liquid. I don't have to worry about him. So I'm going to lend my cash at a lower rate compared to what I would have gotten had I lent to you at a much higher rate. And what happens to the posted market rate? It goes down because of lower quality credits are being shut out of the marketplace. They are becoming more and more illiquid. They're becoming more and more desperate. They're becoming more and more illiquid. But the actual market rate, the posted rate that we all see, is misleading because it only applies to a narrower and narrower segment of the market who happen to be the better quality credits in the market. So if you see these unsecured rates or any real market rate that goes down like that during these periods of time, you shouldn't think, oh, there's way too much money. Central banks are doing a great job. I mean, that's a possibility. But by and large, if everything is on fire, you should probably say, yeah, this is probably the other thing. This is probably where the market is breaking down, and the posted interest rate, the market rate that we all see, is only applying to a smaller representative, too small representative sample, and the rest of the market that we can't measure, that we can't see, is all over the place. It's haywire. It's chaos. It's disorder. It's deflationary money.
And a lot of people that have said in the past, well, inflation is transitory, they're moving to the camp that we could have a mild recession. I don't think recessions are ever mild, and recessions are not necessarily cured by the Fed's early actions. The Fed can start cutting rates, enacting QE, but still unemployment will go higher.
The bond market would be crushed. The dollar might be crushed. Gold would go through the roof if, in fact, they took that $1 trillion and used it to buy gold. In fact, that trade is the best thing China can do for itself. Yes, they can inflict a lot of pain on the U.S., but it wouldn't be economic suicide for the Chinese. See, a lot of people think that the Chinese are stuck, that they can't dump their treasuries because it would hurt them too, because the value of their treasuries would go down, the value of their dollars would go down, and by crushing the U.S. economy, well, they would also crush their biggest customer. Well, I never bought that nonsense. I think the Chinese would be better off if they stopped vendor financing the United States. It certainly makes sense.
And what happened was they're concerned that this rise in oil prices that they were seeing, that they didn't prepare for, could then create second round effects or second order effects where consumers and businesses come to start to expect rising prices and then alter their behavior in a way that only contributes more to unanchored inflation, which then leads to out of control. So the purpose this July in this particular rate hike was to, okay, yes, we can't do much about oil prices. It's kind of surprised us. Consumer prices have gone a lot farther than we thought they would, but we need to stop this thing before it gets out of control. We need to stop it before consumers and businesses alter their behavior. Otherwise, it becomes entrenched. At least that's what they believe. It becomes entrenched. And then it's much, much harder, much more difficult, and much more painful to get under control down the road.